Hi there and welcome to another episode of Retire Well with Wealth Advice. My name's Joe. I'm here with Matthew, and today and actually over the next couple of episodes we're going to be looking at differences between annuities and drawdown when drawing your pension, which is right for you, and hopefully help you come to a decision if you're coming to that age. This episode we're very much starting with annuities, explaining what they are, how they've actually made a little bit of a comeback in retirement planning over recent years, and hopefully setting a good base so that we can look at sort of what's better for you in the upcoming episodes. Matthew, do you want to start by just a really broad overview of what is an annuity, how does it work?
Yeah, no, perfect. So what is an annuity? An annuity is essentially a product where you have your pension pot, you give that to an insurance provider in exchange for a guaranteed income for life, and you no longer have any investments, any charges, any investment risk. That's essentially all given across to that insurance provider in exchange for that contract of how much will they pay you for the rest of your life. Why are annuities good? Well, they're simple, easy to understand, there's no risk involved, and if you can afford to live on the income that's been offered by the annuity provider, then happy days, you don't have to worry about that ever again. Why weren't annuities so popular over the last sort of 10 years? That is because pension flexibility and pension freedom came along and everyone preferred drawdown, which we're going to talk about in more detail, because there was an element of flexibility and control that you don't get with an annuity, but with that you're taking on investment risk. So the easiest thing if you're watching this episode is to say, if you don't like investment risk or you can't tolerate investment risk, but you've built up a pension over years, an annuity is your starting point of what you could be offered in retirement and what that could look like for you. There are different sort of benefits that can be added into the annuity. Do you want to have a chat through the different sort of decisions someone's got when they look at an annuity?
Yeah, absolutely. As Matthew said, an annuity is about taking risk off the table and having that guaranteed income. What that guaranteed income looks like very much depends on how you set up the annuity to start off with. We'll very much look at essentially purchasing an annuity with your pension pot, and then can look at sort of other options a little bit further down the line. So generally when you are purchasing with a pension pot, the first option you've got is essentially, do I take my 25% tax-free cash that we spoke about in previous episodes out before I purchase the annuity, or do I shove that sort of 25% tax-free in there as well to get sort of a larger income over the course of the annuity timeline? I think the majority of the time when we're looking at that with clients, it usually makes sense to take that 25% tax-free out if the remaining annuity will let you achieve what you can do. The reason for that is annuities when purchased from pensions are sort of taxable in the normal way that income from employment or something like that would be, with the exception that you don't pay national insurance on an annuity. Therefore, by taking out a nice bit of tax-free cash, you can have that, use it to spend on holidays, any gifts, lump sums, that sort of thing, and then you've got the annuity that will provide the guaranteed income.
Yeah, I think you're right. I think 99% of people prefer to have the tax-free cash and have the lower annuity. The only time we've seen people go, I'm willing to give up that tax-free cash to have a higher income, tends to be if they've got other pensions and other sources of income, for example, property or other things, and then they say, okay, well, I really want as much of this guaranteed income as possible, so therefore I will sacrifice that tax-free cash to have the higher income. Some older annuity products or older pensions have what's called a guaranteed annuity rate, so they are offering higher terms than the market is offering currently. Again, that's another reason why someone might say, I'm willing to sacrifice the benefit of the tax-free cash to have more of my pension go in at that higher rate, and I'm therefore doing better than the market and squeezing out as much income as possible.
Yeah, it's worth mentioning as well sort of the practicalities of sort of taking an annuity from a workplace pension. The starting point a lot of the time is that the scheme or the workplace pension you have would essentially offer you almost an internal annuity, whether that's a guaranteed one that's been pre-built in, or just the provider that they use.
Yeah.
You always have the option of looking to the open market, conveniently called the open market option, where you can essentially look at the pension pot you have, go away to other annuity providers or a financial advisor to see what other options you have available for yourself.
Yeah, definitely. And I think for everyone who is at retirement and gets a letter from a provider and says, this is your guaranteed income source, rightly they should be saying, okay, well, a bit like shopping for car insurance, I'm not going to take the first quote I'm given there, I'm going to get an open market quote. So that's where, someone like ourselves, independent financial advisor, can say we can review the whole marketplace and find the right and best provider for you. Essentially, what you want to do is make sure that you're squeezing out as much income as possible for yourself and your family over the long term, and by getting that open market quote, that does that. The other sort of thing that people should think about is, what are they trying to do with the annuity? So is the annuity providing for just a single person, or do they need to build in protection for a spouse or protection for a family? Before we go into all those different almost bolt-on options for the annuity, let's just touch on what you said before on, there's been a bit of a resurgence and there's been a bit more demand for annuities recently, and that's been because in a high interest rate environment, the level of guaranteed income on offer increases. So when the base rate was 0.5%, you essentially have very low annuity rates, and therefore people say, okay, well, if I give up all of my pension and the guaranteed income offered is quite low, I don't really want to do that. And that was almost pushing people down more of the drawdown route of staying invested, having to be comfortable with the investment risk, but knowing that they could get potentially higher returns and more income from it. As interest rates spiked and as we saw those higher figures, we really saw a lot more people saying, okay, well, if that is a higher income on offer with no ongoing charges and no investment risk, they sort of said, okay, yes, that can meet my financial needs.
Yeah, absolutely. And to try paint a picture, as we probably know by now, I love a figure to sort of compare, very much a numbers guy. Now, sort of, if you were to buy an annuity as of, I think it was 4th of February that I looked at this, 65-year-old with £100,000 on sort of a standard annuity, so none of the additional bits that we're going to look at in a second, could come around with sort of around £7,500 per annum. The sort of low point in recent history is 2016, which, as Matthew said, the base rate was really low, interest rates were really low. You could actually get almost £2,500 less at around £5,000. And although 7,500 is high compared to sort of recent history, this isn't as high as it was sort of back in the mid to early 2000s, and even before that, again, when interest rates were much higher in sort of the late 80s, early 90s.
Yeah, definitely. And I think, whilst annuities came back into sort of the consideration with the interest rates being higher, it was still always there as the no risk option. So again, the person who said, I've thought about investment risk, I've got to understand it, but I still just don't like the idea of my future income fluctuating or my pension fluctuating in retirement, that person would still have gone, even with those lower figures, probably said that was the right option for them. Crucially though, what they had to think about was, the bolt-on bits to the annuity. So let's jump in and think about that. An annuity is a lifetime income, so it's a guaranteed income for life of the person taking it out, but you can build in a guarantee period, so that's how long, if you were hit by a bus, how long would that income continue to be paid to your beneficiaries. You can also have a joint annuity where you're saying, actually, well, I've got a spouse as the typical one, where I want to leave 50% of that income to the spouse, so if I'm hit by the bus tomorrow, 50% will carry on being paid to my spouse, as well as potentially having that guarantee period that kicks in. And you can also pick the escalation amount. So if you are thinking about inflation, do you need your income to be level in payment and therefore naturally eroded by inflation over time? Or are you saying, actually, I can see my expenditure being very consistent throughout retirement, and therefore I'd rather have a lower initial income but keeping pace with inflation?
Yeah, I think the big one is that inflation-linked annuity that sort of most people are speaking about at the moment, given what we've experienced over the last few years.
True.
Because if you took out an annuity in, say, 2020 on a fixed basis, the buying power of that annuity, the amount that you can actually buy with your annual income, will have dropped drastically.
Will have eroded slightly, yeah.
Yeah, as Matthew said, you can put in inflation linking on that. So with that, there'll be a few different options. You could potentially look at increasing it with the retail price index, so sort of a general measure of inflation.
Yeah.
Or you could also look at just increasing that annuity each year by 3% fixed.
Yeah.
The drawbacks, obviously, of that are the provider's going to pay you more over the longer term as inflation goes up. Therefore, they will sort of reduce the amount that they give you on an offset.
Yeah.
Sorry, Hugo.
I was going to say happy to be challenged, but the majority of clients that we talk to who are looking at annuities say, I'll spend more in the early years of retirement and spend less as I get older, plus I've got other things like state pensions to kick in, so I'm happy with the level annuity, knowing that the spending power will decrease over time. Where do you see the biggest sort of risk on that one?
Yeah, I think I'd probably agree with you with the fixed in most cases makes sense. When we look at it with clients, we usually try and find what the potential crossover would be. So where are you going to be better off with an inflation-linked annuity or a fixed annuity? Obviously, that heavily relies on assumptions. We've got to assume what inflation is. So were we expecting sort of 10+% inflation previously? No. So then maybe the crossover is slightly different. But generally, we usually see the sort of crossover in the late 70s, 80s. And as you said, at that point, a lot of people will have done all the travelling that they're wanting to do. They've sort of spent the sort of the majority of their early years of retirement doing all the big things, and then start to wind down a little bit and maybe not spend as much.
Yeah, I think we certainly see people in their late 70s and early 80s spending a lot less than in their 50s and 60s when they're enjoying the golden years of retirement. So I often frame the annuity and the level annuity. Inflation is allowing you to have more of your income up front with the level annuity, and inflation is then sort of tapering that off over time. Knowing that other sources like the state pension have the triple lock and are preserving their spending power, people can then almost sometimes or most of the time tolerate that. Again, if someone is interested in annuities, they shouldn't be they're not asked to decide exactly what they want and then just to then find out the income. We do a range of quotes for someone to say, this is a level annuity, this is if it goes up by 3% each year, this is if it goes up by the RPI, which of these income levels and the long-term plans work for you. I think the most interesting one recently has also been the guarantee period, because people logically go, okay, I'm married, therefore I want to have a joint annuity. When we compare an annuity that pays out 50% of the income to a spouse when someone passes away compared to an annuity that has a, say, 30-year guarantee period, 30 years of the full 100% is often a lot more beneficial than an unknown number of years at 50% if we don't know when someone's going to pass away or even when their spouse might pass away. So more and more we've been doing that exercise to say, what do you want? But given there's no residual pension or pot left, people like the idea of the death benefits of husband and wife, if both of them were no longer here, that a guarantee period would still pay out to that individual's estate.
Yeah, and I think that again is another reason why annuities are a little bit more popular, because that longer sort of 20, 30-year guarantee period is something that's very much only become more common with providers recently. Previously, it might have been sort of limited to a 5-year guarantee, 10-year guarantee, which is obviously, if you're buying one at 55, it's not that much use when life expectancy is up in the 80s.
Yeah, I had an individual the other day who said, I've got a £200,000 pension, I'm interested in an annuity, I understand the difference between the guarantees, a 5-year and a 10-year guarantee, but then they sort of said, okay, well, if I was to pass away and I've only had 10 years worth of income, where does the rest of the money go? Well, that's the one, if you don't build in that longer guarantee period, the insurance provider is the winner in that case, and there's not a pot of money waiting to go and be paid out. You've given 100% of your pension across in exchange for that contract for the guaranteed income for life. If you live to 100 or 110, you're the luckiest person alive and you've had brilliant value for it. if you get hit by a bus the next day after the annuity's been set up, you're the unluckiest person alive, and you only get the guarantee period. So that individual said to me, well, if I'm giving up my 200,000, I want to at least ensure that my family are getting £200,000 worth of income. I don't like the 5-year guarantee of saying, okay, that might give me 50 grand worth of income, but where's the 150 gone?
Yeah, I think that's interesting you say that, sort of when you want to get at least 200,000, the amount that you put in. More often than not, when you're looking at a longer guarantee period, like 20 or 30 years, you'll actually find that the payout will be more than the initial sum you put in.
Yeah.
So that sort of 7,500 on £100,000, if you put a guaranteed period of 20 years on it, might reduce to 6,000, something like that, just for argument's sake. Yeah. 20-year guarantee period would essentially pay out £120,000, an additional £20,000 to sort of what you put in. A few people are saying, is that too good to be true? Surely the provider's losing out. The difference there is that the provider has your money, and that money is being sort of invested in the background, which allows them to sort of make a return while providing you with more income.
Yeah, spot on. I think essentially in that analogy, someone who wants to take out annuity isn't willing to take investment risk themselves, but the insurance provider, the annuity provider, is willing to pool the funds and to make a return, and therefore that's where they can offer those income levels over the long term. One question people typically have for us is, how often are these rates changing? And if I get a quote today, is that going to be a similar sort of figure in the next sort of month or two?
Yeah, I mean, it very much depends on what your personal circumstances are to sort of how much an annuity you can get. The bit that we're going to talk about in a second is looking around sort of enhanced annuities, but more broadly, the pricing of annuities is based on a number of things. The providers will look at your age as sort of the most basic one, look at what your life expectancy is and the mortality rates for people of your age, and then essentially we'll work out how much income they might pay you over the course of the lifetime. It is, as Matthew's previously alluded to, it's affected by interest rates. So recently the Bank of England have reduced the interest rate, base rate, which means annuities are likely to change there. One thing that when I first entered the industry I found quite interesting and didn't realise was a thing is that annuities are actually based on your postcode as well.
True.
So it doesn't just look at sort of the life expectancy for the full country. If you're in a postcode which is maybe got less life expectancy, you're likely to get a higher annuity.
So it's worth moving to a rougher area before you take out an annuity,
Yeah.
Is that what you're saying?
Yeah, maybe.
It's not quite as simple as that for anyone who is watching. But yeah, certainly I think, the annuity is a really good option for someone who is a low risk person and wants stability. I think what's also interesting is how it can be used with drawdown. It's not an all or nothing sort of thing. So that's jumping ahead to sort of one of our frequently asked questions is, do I have to use 100% of my pension or all of my pensions if I've got multiple pots to buy an annuity?
So short answers no on that one. Next question. No. So with pension pots, you can use as much or as little as you want from your pension to purchase an annuity. As Matthew said, quite often if no one's got any guaranteed income other than the state pension, so they don't have a scheme pension at all or a DB pension from an older type pension, they may want to use some of that pension fund, so maybe 50 out of the 100,000, to go ahead and purchase an annuity that's going to give them a little bit more guaranteed income until they sort of get to retirement state pension age, when they'll have much more, and we find that actually allows them to take a little bit more risk potentially with the remaining pension sum, keep that invested and hopefully grow it over time.
Yeah, definitely. I've got a good number of clients who have had large pensions invested, and they say yes, they're happy with risk, but they also know they've got basic expenditure and they know what that looks like. So they've used a portion of their pension to get the annuity to cover that, often trying to tie it in with something like a tax allowance. So, the perfect scenario, you could have 12,570 worth of taxable annuity income using your personal allowance, meeting your essential expenditure, and then have the rest invested so that you can have the growth on your pension and you can then draw down as and when you need to meet your income needs. That is certainly, a common popular strategy that we've had with clients.
Yeah,
I like to call that one the Hovis approach because it's the best of both. You've got the guaranteed income source on one side and you've got the flexible drawdown on the other.
Yeah, exactly. It doesn't have to be Marmite, one or the other. Can be both.
Other breads are available.
So another sort of, I suppose, retirement myth that we have there is that annuities are just for retirees. You can only use them with your pension pot and you can only use them at retirement. Obviously, it's not the case. You can have purchase life annuities. You can actually get them all the way from age 35 onwards. I was in a seminar with a couple of other advisors last week, and that's quite common for football players or professional sports people in the main because they retire early but don't have a guaranteed income. Do you want to just walk through sort of purchase life annuities?
Yeah, essentially in the exact same way as a pension is given across to an insurance provider in exchange for that guaranteed income, you can have the same thing but outside of a pension. So if this was a pot of money, I had one previously where someone sold a business and said, what do I do with these sale proceeds? Again, because that's naked, it's not within an ISA wrapper, it's not within a pension wrapper, it's just cash. You can go to an insurance provider and say, okay, if I give you my £200,000, what guaranteed income will you give me for life? And in the same way we've discussed with the annuity, with the pension, they can do that. The only sort of main difference is to say, okay, someone doing that could be younger, as you described, so therefore the return could almost be lower because it's for a longer period of time being guaranteed for. And the other side of it is you then have an element of it which is completely tax-free because that's return of capital, and then there's some interest charged on the top bit because essentially that is saying there's a growth and a return there, so they have to work out the equivalent way of taxing it. But I've had that as, a brilliant way of saying someone knows what their expenditure looks like, so they know what they want to produce as a guaranteed income, and then the funds on top of that could be invested or could be put into ISAs pensions over the years to provide that longer term flexibility. Again, going back to that, having one eye on basic essential expenditure, one eye on a guaranteed element, but also saying I still want some flexibility and having that best of both approach.
Yeah, absolutely. And on that sort of pension and do we have to use the sort of annuity when you take your retirement, there's nothing stopping you doing drawdown, which we'll discuss in the next episode, and taking a flexible income, and then getting to a point where you go, actually, I've done all the spending that I want, I now just want a guaranteed income, and you can purchase an annuity then as well.
Yeah, I think just before we wrap up, the main thing we should just touch back on is that guaranteed annuity rates, because if you have pension provider paperwork and it's saying you're getting something guaranteed or you're something that you would lose out by moving away from, that should be alarm bells. You should say, okay, I need to make sure I'm getting the best use of this guarantee, and also you don't want to accidentally move away and lose it. So people often say, yes, I can see I've got a guaranteed annuity rate, but it doesn't let me pick the terms. So it might be a level annuity, it might be single life, and it might be a 5-year guarantee. It might give me double the income of the open market, but it doesn't let me pick those terms. That is a tough one for someone to work their head around and to say, does that double the income, provide me with more benefit, or do I actually want to give up the guarantee to move to the open market and have flexibility to pick it on my terms? Someone in that situation should definitely be getting in touch with an independent financial advisor for advice, because it is a dangerous thing that you don't want to lose out on a guarantee. And crucially with annuity, once that contract's signed, once the pension's paid across, it's irrevocable. You can't go back. There was talk of a secondary market and there was talk of people being able to sell or buy back annuities. That's never happened. So you have to be, very, very confident in the decision you make, and that's why lots of people do look to get formal advice in this area. Yeah,
absolutely. And on the topic of formal advice, another reason why you might want to get in touch with an advisor is potentially if you're in impaired health or you've got poor health, because then you could sort of look at an enhanced annuity option,
great point.
Which, apart from the sort of usual stuff of having increase due to your age or you're potentially a poor postcode, if you've got something that potentially limit your life expectancy, so a long-term illness or disability, the provider will essentially account for that. Smoking can also be another one where you can get an increased annuity rate.
Yeah, certainly. And I think, basically there you're saying, again, goes back to that old phrase of you want to have good value for your own income. So if you're not expecting to have that full life expectancy, you want to ensure you get good value from the annuity. I think the only limitation we found with people looking at that is you can almost sometimes providers say, well, we're going to have a reduced guarantee period. So again, you can't always have your cake and eat it. You can't have a higher income because of a reduced life expectancy, but then bolt on a 30-year guarantee to provide for a spouse or a family. So again, lots of little bits to work through, but you're right. You wouldn't want to have a standard annuity if you were expected to have a reduced life expectancy. It would be a foolish decision.
Yeah, absolutely. Final sort of bit of retirement myths, I guess, for the episode before we sort of wrap up and move on. This is actually something that's changed over the last sort of 10, 15 years. We've talked about life expectancy. Men and women obviously have different life expectancies, with women projected to live more than men on average. Does that mean women can get sort of a higher annuity rate than men, Matthew?
So annuities don't take into account anyone's gender. There's been a sort of an equalisation, so it's based on your age, your postcode, but it doesn't look at your gender. You can argue on that side of things, if women are living longer, they might do better from an annuity. And does that seem unfair? Well, when we had briefly had that chat, flip it the other way round, and insurance premiums for whole of life or car insurance or other things, they're equally equalised as well. So overall, it probably plays out in the norm. But yeah, annuity providers can't factor in gender when they're making their sort of quotes.
Yeah, absolutely. So what would you say of sort of the key points for today to take away and sort of move on from?
I think the key takeaway is an annuity is the risk-free option for retirement, and again, that can be a great default quote. So, to understand what an annuity could give you, great starting point. If you can afford retirement with an annuity, brilliant. If not, and if you do like the idea of investment risk for the long term, that's when you should move on to think about drawdown or potentially a best of both approach.
Okay, fantastic. So as Matthew said there, next episode we'll be looking a little bit more on the drawdown side of pensions, and then moving on to drawdown versus annuity, what's right for what type of client.
Definitely, and I think we're keen to sort of debate scenarios. So again, if anyone's got any real scenarios or real questions to leave in the comments, just send them across and we'll try and discuss that in a future episode.
Okay. Fantastic. Thank you very much for watching. As always, new episodes every Tuesday, and look forward to speaking next time.